The basic accounting equation. The accounting formula represents the relationship between the assets, liabilities, and owner's equity of an entity. It is necessary to understand the accounting formula to learn how to read a balance sheet, which is also known as a statement of financial position. The basic accounting equation is A equals L plus E. Now let's break the formula down into smaller parts. In the formula, the A stands for assets. An asset is an item of economic value in possession by an entity which can be converted to cash. Assets can be tangible, such as equipment, inventory, and cash, or intangible, such as software, goodwill, and trademarks. The L refers to liabilities. Liabilities are a legal debt or obligations that arise during the course of a business's operations. Liabilities are settled over time through the transfer of economic benefits. What this means is if a business decides to pay off a loan with cash. In the accounting equation, the E stands for equity. Equity is the difference between a company's assets and their liabilities. It represents the share of assets that are claimed by the business and the business owner. Equity is broken up into two parts: contributed capital, which is the amount invested by shareholders, and retained earnings. Retained earnings are the percentage of net earnings not paid out as dividends, but retained by the company to be reinvested in its core business or to pay its debts. The balance sheet gives us a snapshot of the financial position of an entity at a given point in time. In this example, we see that the total assets of $910,000 is equal to the total liabilities of $450,000 plus the total equity, which is $460,000. This all up gives us total liabilities and equities of $910,000. Therefore, we see that A equals L plus E. So our balance sheet is balanced.